What's up, everybody? Welcome to Heresy Financial. My name is Joe Brown, and right now there are many concerns from many people about inflation, high inflation, and potentially even hyperinflation. Now, given the fact that the broad money supply has increased in the United States by over 25% in just the last year, this is not a surprise. Further than that, the Federal Reserve has indicated that even if inflation does show up in the official inflation metrics, they will do absolutely nothing to stop it. Now, why, you may ask? Isn't that their job? Well, they say that the inflation, if it does show up, it will be transitory. That means temporary. They're basically saying if inflation shows up, it'll go away on its own. But what if it doesn't? What if it's not transitory? What if this inflation, when or if it pops up in the official metrics, what if it doesn't just go away on its own? We've seen many times throughout history when an overabundance of monetary expansion, money printing, leads to high or hyperinflation. Consequently, this has led many to start searching for a hedge or multiple hedges against inflation. Some of the common hedges used historically, things like gold, sometimes real estate. More recently, people are looking at things like Bitcoin as a hedge against inflation, and sometimes people use stocks as well as a hedge against inflation. And so in this video, we are going to look at how well stocks or how poorly stocks perform and hedge against inflation, especially during times of hyperinflation. Ready? Let's dive in. All right, a couple of things to note before we start looking at the charts. We're going to be looking at a number of charts here. If you are listening to this, the audio version on the podcast, don't worry, I will talk through everything so you don't miss out. Second, I've talked at length before about the economic theory behind how and why inflation happens, what monetary expansion does to prices and asset prices, why it works out that way, and due to what's happening right now, making a case that inflation and very high inflation is very near in our future and starting to happen right now. That's not in this video. That's not what I'm doing here. I'm not making a case for inflation. We're specifically looking at historical examples of high and hyperinflation and what stock markets do during that time. That way, if you are concerned about inflation wherever you live, you can make a more educated decision about what to do with your money. Okay, first, let's look at this chart. This is a chart of the UK and the United States of America over the last 120 years. On one side, we have nominal or total returns. On the other side, we have returns adjusted for inflation. So starting off in the year 1900, if you put $1 into the United States stock market and just let that ride today, you would have almost just about $70,000. That is an average annual compounding return of 9.7% per year. Now that sounds fantastic until you factor in the official average inflation rate of 2.9% per year during that entire time. It reduces your total return from $70,000 all the way to a grand total of $2,300, just about $2,291. Now that's still a positive return, but what you're seeing here is that once you adjust for inflation, you get the real growth rate, which is 6.6% per year. That turns $1 into $2,291 over the course of 120 years in terms of real purchasing power. Now, in actuality, if you put $1 in, you would actually have just about $70,000, but it's not going to purchase for you the same amount of stuff as $70,000 would purchase for you back at the beginning of 1900. Instead, that's going to be worth about $2,291 in terms of the original purchasing power. We get a similar relative picture if we are looking at the UK. If you invested $1 in 1900, today you'd have $39,000 in the UK. That's an annual growth rate of 9.1% per year. The inflation has been a little bit higher there though at 3.6% per year, which leaves you with a real return of 5.4% per year, meaning that $1 invested in 1900 would have the purchasing power of $572 after 120 years. That's a far cry, but a couple of things that we need to take away from this. Number one, there's still real growth in equities. Number two, none of this is hyperinflation. We're looking what a normal market does under moderate inflation over a very long period of time. Number three, what this shows is that while the real return is nowhere near what the nominal return would suggest, the inflation that hits the society, the economy, boosts the stock market prices so much so that it compensates for the loss in the purchasing power along the way. And that's what you're looking for with a hedge. It means you want to make make sure that if inflation happens, you're at least preserving the purchasing power that would have been there anyway without that inflation happening in the first place. And that is exactly what we see happening here. The nominal amount goes up in accordance with the amount of money that was printed, on top of any growth that actually takes place. Now let's take a trip back in time to a very shorter period of history that is much longer ago, where there was actual real hyperinflation instead of a long protracted period of low inflation, relatively speaking. We're going to go back to the notorious Weimar Republic in Germany following World War I. As you're looking at this chart, you can see that the black line represents the stock market as measured in their local currency, the marks, and the blue line is going to represent the stock market measured in the United States dollar. Now remember, at this time, the United States dollar was fully backed and pegged to gold, meaning that this is an accurate representation of purchasing power. The dollar was as good as gold here, and so when you're looking at this, you're actually seeing a real gain in purchasing power in the German stock market. Yes, they were having hyperinflation. Yes, the purchasing power of their local currency was falling extremely quickly, approaching zero very quickly over the course of just 4 years here. But that caused money to pour into the stock market. Much of the new money that was created poured into the stock market, pushing the price up so much so that especially in the last year, when things really went parabolic, you saw an increase in purchasing power in stocks, despite the fact that there was hyperinflation going on. So there was massive nominal growth and there was still decent real growth. All right, now we're going to look at some modern examples because hyperinflation isn't something that is relegated to the past. Let's look at Argentina now. And we can see on this chart in Argentina, the inflation rate right around 2014 started to take off. It was around 10% and it has gone up dramatically since then to right now it's about 40%. It has been volatile, and so you see spikes and drops in the inflation rate, but the actual inflation rate is still very high. So, for example, just as a side note, if we see here in 2019, it peaked almost at 60% and has been on the decline since then. It's still high inflation. The inflation rate is declining though, and this is what people call disinflation. It's when there's still inflation, but the rate of inflation is dropping. It's still there, it's just decreasing. So 40% inflation, 50% inflation is very high, but compared to maybe last year, it's dropping. And so that's what people are referring to when they say the word disinflation. Now let's look at the Argentina stock market. You can see, again, during 2019 here, look at when the inflation rate was dropping. Even though it was high, the inflation rate itself was dropping. You had massive volatility in the Argentinian stock market. But still, despite that, during the time, while inflation overall is growing and spiking, you have a massive growth in the stock market. Let's look at another great example. Let's look at Venezuela. When we look at Venezuela, we have to look at this broken down into two charts just because it is so extreme. We're going to look at this first chart. It's 2012 through 2016, and right around 2016 especially, the stock market there starts to go parabolic. 20,000, 40,000, 60,000, 80,000 just within the course of 6 months. But when we fast forward then and look from 2016 through 2020, we see the same thing, and the parabolic spike in 2019 is so extreme that it makes what happened in 2016 look like a flat line in comparison. Now you're looking at the chart and you're saying, hey, look at the axis. It's 20,000, 40,000, 60,000, 80,000 again, and that's simply there because they chopped off the zeros. They decided to reprice everything, chop off the zeros. Still, percentage-wise, relatively, that growth was still happening. And Venezuela, we know what's going on there right now. I mean, it costs about a week's to a month's worth of wages in order to buy a hot dog at a hot dog stand. The conditions there are almost unlivable. You might be thinking what I just said there and thinking, hey, if you have to work for a week to a month in order to afford one hot dog, that means nobody can afford that. Nobody's buying that, which means there's no revenue coming to businesses, which means nobody has jobs, which means nobody has wages. That's not possible for that to be sustained. So that can't actually be happening. And the solution is families are sending one person out of the country to go work in another country with a stronger or more stable currency, and they're sending money back. So nobody has enough money in local wages and local currency to live off of what they're actually earning and producing. They're relying on external sources of income coming into the country for them to be able to afford basic necessities, which means that when you look at the stock market versus cash, it is unquestionable that it would be better to hold your wealth in stocks versus cash, even if you're losing purchasing power. in the stock market. You're not losing it near as fast as you would be if you just hold it in cash. Now let's look at Zimbabwe, just another recent example. We can see here on this chart from 2019 to 2020, their stock market again just went parabolic. In the course of about 6 to 7 months, the stock market's return measured in their local currency was about 5 times. Of course, when you measure this in US dollars, you're going to see a loss in real purchasing power here. But again, when you look at the nominal price this is increasing by, that means that in nominal terms, they're preserving their purchasing power in their local currency far better than they would if they were just holding on straight onto cash. And finally, we need to look at a most recent example, which is Lebanon. And it is so extreme and so recent what is happening in Lebanon that some of the data here is not even up to date, because even just over the last couple of weeks, the inflation rate in Lebanon has been spiraling out of control. It might end up being a world record, just not necessarily one that you want your country to be known for. So much so that just in December, food prices in Lebanon skyrocketed 400%. Astronomical, devastating price inflation there due to far too much money printing and then a collapse in the confidence and a collapse of the purchasing power of their currency. But we can see this unfolding over the last year. If we look at their inflation rate for a couple years, it was steady below 10%, which is still high, but it was under 10%. They weren't yet in hyperinflation territory really until the beginning of 2020, and that's when things started to get very bad in Lebanon. 20%, 40%, 100%, all the way up to 140% there at the end of 2020. Astronomical inflation there. And if we then look at the Lebanon stock market, the Lebanese stock market, we can see that the stock market was crashing until the printing presses really started to get fired up. That's when the drop in the stock market stopped. It stalled, started moving sideways, and then recently, just over the last couple of months, it has gone parabolic. Again, due to the most recent amount of money that is being printed. And so, is the stock market the best place or the perfect or the ideal hedge against inflation? Probably not. Are you losing some purchasing power when you invest in stocks during periods of high or hyperinflation? You very well could be, especially short term. Things can be very volatile. But the question isn't whether they're the best, the question is how they perform. And undoubtedly the data shows that stock markets go up and increase in nominal price, usually on par with inflation. Sometimes more, sometimes less, but it's indisputable that it's better than holding cash. Now I want to drive this point home because it doesn't matter if they're the best form of hedging against inflation. Many people own stocks, and many people during periods of high inflation start to look at the valuations of stocks and think that there's a stock market bubble. They think stocks are overvalued, and so they sell and hold cash, not realizing that it's not the stocks that are becoming overvalued, it's the purchasing power, the value of the currency that's actually crashing. So history shows that whether there's long protracted periods of low to moderate inflation or short bursts of hyperinflation, stocks don't do a bad job of hedging. Now, if you're investing in stocks because you're anticipating inflation, but you're also concerned that there might be a deflationary crash, some deflationary event that causes a big stock market crash, and you're concerned about that, check out my beginners and my advanced options courses linked in the description below. I teach you how to use basic and advanced option strategies to hedge, speculate, and trade for income. As always, I really appreciate you guys. Thank you so much for watching. Have a great day.